Good morning. Welcome to Market Monday. Well, 3 weeks into the year and the battle continues. Bulls versus bears, soft versus hard landing, recession or no recession. Adding fuel to that fire, of course, was last week's headline CPI inflation report for December, showing a 6.5% year-over-year gain and a 5.7% core inflation, which removes food and energy prices. No doubt market watchers will tease apart the report in coming weeks, goods versus services or services without housing. For today, we can say the trend of slowing inflation continues.
Let's have a look where we currently stand. Now, we don't put much weight at all in 2 weeks of market performance. We see so far for the year, again, just a few weeks, low single-digit gains for all major US stock market indices. But let's remember where we came from over here. Even though most of these peaked around the fall or winter of 2021 or in early January of 2022 in the case of the S&P 500, here's the max drawdown over the past year. And right here is how far off those lows we currently are. We've been here several times before over the last year, each time turning out to be the bear market rally, where the stock market has these rallies amid an ongoing bear market. Look at March, May, July, and August, and essentially coming off the lows for the year in mid-October.
Which again has the bears calling the start of this year just another bear market rally. While we focus most of our attention on the larger publicly traded markets, after all, that's what our clients own, that's who pays the dividends and so forth. It can be helpful to look at what small businesses are saying. They say small business is the backbone of America, right? While Apple or Microsoft has a ton of power and control in their financing and operations, your local restaurant operator, builder, or law firm may not have the same position. And market watchers often look here for the first cracks within the economy before they show up at the Apples and Microsofts. The most prominent small business association is NFIB, National Federation of Independent Business. They publish great data and surveys for membership. Let's have a look.
As Chad just mentioned, financing or credit conditions is crucial to small business. We see here the NFIB small business expected credit conditions have fallen to the worst in a decade. By the looks of it, we haven't reached a bottom yet. We suspect it has to do with both availability of credit, the willingness of banks and institutions to lend, and also the cost of credit, which has been rising rapidly as Fed Chair Powell is on a mission to squash inflation. We note that in 2008, when the financial system as we know it was on the brink of collapse, we see a significant deterioration in this index. However, we don't get that same severe deterioration after the dot-com crash. It looks more akin to this current bout of deterioration. So we keep a close eye on this to monitor, is there further deterioration or do we start bouncing up and down here like we did in the early to mid 2000s?
We know supply chains and input costs have been a major challenge for small businesses over the past few years. The blue line here is price pressures for small business. So a rising line indicates rising price pressures. See that ripper from the COVID low peaking sometime last year? A pace not seen in the last 22 years. This orange line are the plans to raise prices in the next 3 months. We see for the last couple years, small business had a harder time raising prices to offset higher price pressures. Something larger, publicly traded companies are usually better positioned to do. That's the blue line, price pressures, exceeding plans to raise prices. This is a stark contrast from the past 2 decades as we see a consistent tendency for raising prices, the orange line, to be above pricing pressures. We do suspect a reversal back to this relationship at some point, though the challenging credit conditions Matt just mentioned will likely cause that to take some time. Either way, we're glad to see both pricing pressures and expectations to raise prices plunging.
Labor is one of the largest costs of a small business, but the humans behind the labor are often a small business's most valuable resource. This blue line is job openings hard to fill. Remember this? When every window had a "now hiring" sign on it, and restaurants were closing half the tables because everyone was short-staffed? This is 40 years of data going back to before 1980. So that extreme period appears to have peaked and back on its way down. But the orange line, hiring plans, is also coming down, albeit still at a fairly high level over the past 40 years.
Perhaps this has something to do with that. Employee compensation in blue, this familiar almost straight line up, peaking, though still extremely high over the past 35 or 40 years. Plans to raise compensation in orange, also still high, continues to tick lower in the recent data. This, combined with some of the froth coming out of the tech sector I was talking about last week, could lead to a more balanced labor market in the years ahead. Yet another arrow in the quiver of our theme this year of markets seeking balance.
When we zoom out and look at small business at the aggregate level, we see easing price pressures, falling plans to raise prices, lower hiring expectations, a slightly easier time finding labor, peaking employee compensation and plans to raise compensation, which all seem to bode well for small business, but also deteriorating credit conditions and how far those keep falling.
Let's wrap today with a back-of-the-napkin calculation from the Social Security Administration. According to the SSA, due to high inflation, approximately 70 million Americans will get an 8.7% COLA, or cost of living adjustment. They say on average that increase equals more than $140 per month. That's just the increase on top of the benefits they were already receiving. So let's say $140 per month times 12 months, that's $1,680 per year per Social Security recipient. So 1,680 times 70 million beneficiaries. Wow. That's over 117 billion extra dollars being pumped into the economy that weren't there last year, on top of the over $1 trillion the Social Security Administration paid out last year. And guess what? This number won't go down along with cooling inflation in years ahead. We think this is significant and will support business, both small and large. Have a great week.